But we've got the management of Metropolis waiting to chat with us. The stock in the last 1 year hasn't given any return. It's only up close to about 3%. The street is concerned about the increased competition in the diagnostic space. But has that competitive intensity eased a bit? What's the current landscape right now? Because we haven't seen too many new entrants in the diagnostic space. We are now joined by the promoter and the managing director of Metropolis Healthcare on the show now to talk about the way forward. We've got Ms. Ameera Shah with us. Thank you very much for joining in. Can you talk about how competition is? Has the discounting eased, at least from the new tech players? Just tell us competition right now and the way forward, according to you.
Hi, good morning. So I think, there's been a lot of confusion around the diagnostics industry in this past year. And I think people have assumed that, revenues or profits have been impacted because of competitive intensity. But actually, in reality, the reason we've seen 22-23 obviously be a little lower than the year before that has been more because COVID has come off. And because of that, it impacted the revenues and the profits of all organizations in the industry. Actually, if you look at the non-COVID, if you look at our core business in FY22-23, it grew at about 15%, of which 13% was volume growth and 2% was a revenue per patient growth. So actually, which is very similar to what it was pre-COVID. So competition has come in, of course, in a bigger way. But frankly, in our industry, we've seen competition for the last 10 years. It's not something very unusual. We have seen online players. We've seen some corporate entrants as well. Having said that, in the industry, we have to realize that diagnostics is not one big industry. It's actually nuanced sub-segments of the industry. So it really depends on where you play. Metropolis really has spent most of our time in the illness sector, and that too in the more critical illnesses. And therefore, when doctors and patients are coming to Metropolis, they're coming because they truly need good quality results where they're very sure of accuracy. The moat around the business is more around the trust and the credibility which the brand enjoys, which frankly takes time to build, is difficult for any new entrant to build overnight because it requires very fundamental expertise. So we have seen competition come in. Metropolis has not seen any large impact because of that. We are continuing to grow well in our core business, and we expect to do the same next year.
Have you undertaken any price hikes in any of your tests?
We have actually in the last 2-3 months, we've taken some price hikes in about some variety of the tests. So actually our normal way of doing price hikes is never at one time, all tests at all locations, but we usually do different locations, different test categories at different times of the year. So we just did one as of April 1st, more in the specialized segment, a few hundred tests and marginal increase is about 4-5%. So I think overall, we're continuing to see that price increases are possible. We are continuing to see that even though competitive intensity did come in and discounts did go up, we are starting to see those discounts ease because we are also seeing that competition is understanding that discounting doesn't get you very far in healthcare. You really have to build expertise.
Patients are one end of the spectrum. The other important stakeholder are your vendors and your franchise partners, etc. All competitors have perhaps also understood that for them to grow, they have to expand their network. In that situation, how's the bargaining power of franchisees and partners been? I mean, has there been any change in revenue share? Are they pushing for a higher share of their revenue, given they have other options now as well, poaching in this space?
So actually, we have to understand the role of a franchise, at least for Metropolis, is more of a service provider where they actually collect the sample when our patient walks into that center. If it is a B2C franchise center, and also we also have B2B franchise centers where they only pick up samples from hospitals and labs. But when a patient walks in, the demand generation is done by Metropolis. The service fulfillment is done by the franchise. So even when competition comes in and there's always an attempt to poach your franchise partners from you, we usually find that the best quality, the most productive franchise partners never leave because they understand that the business is being generated by the brand and not by them. And therefore, that bargaining power that you're referring to doesn't actually become much stronger in the hands of the franchise, even when competition does come.
Ameera, hi, good morning. Prashant here. Two questions. One, so we should expect 15% growth in FY24 as well. You said similar growth should be maintained. That is point one. And second, when we speak with companies like Dr. Lal, etc., they say that bundled tests, right, many tests together, they become very popular. And that kind of also is a price advantage for consumers, so that's why they opt for it. So are you seeing a similar trend?
We certainly are seeing bundle tests go up. I think it's more not only because of a change of consumer mindset, but also because organizations like us are giving opportunities to consumers to say that, look, would you like to create a bundle package and do more tests since you're giving your blood anyway? Having said that, this is not hitting the profitability of organizations. Actually, it is contributing to the bottom line as well. So I don't see this as a negative way of either reducing the RPP or by reducing the EBITDA margin in any way. On your question, as far as the outlook goes, last year, as I mentioned, on the core business, which is keeping aside COVID, keeping aside acquisitions, keeping aside government contracts, any of those, we saw 15% growth. Going forward, again, I think the 12 to 15% growth on the core business is very doable. As a mixture of volume and price increase. But that obviously does not COVID and acquisitions and government contracts.
So, sorry, overall business revenue growth would be, Ameera, 12 to 15%?
No, I said that would be for the core business.
The core. So what would be the,
COVID will still impact a little bit because this year in 22-23, we still saw some COVID revenues, which are obviously not continuing into 23-24. So there are some adjustments because of other ecosystem areas, but otherwise in the core business, we do believe 12 to 15 is possible.
And just one more number, what percentage of total sales are through these bundled sort of tests now?
For us, it's about 15%.
And that is growing rapidly?
That is growing well. And like I said, it continues to be profitable for us at the bottom.
But it would, just as a layperson, bundling many tests together as against paying for each individually, I'm assuming that there would be some trade-off, right, in terms of pricing as a business.
Of course there is. There is certainly a benefit for the consumer when they do bundle tests. But what we have to remember, if you look at the P&L of diagnostic companies, the servicing cost of a customer is as significant as the material cost in doing a test. So actually, when you're adding multiple more tests, you are incurring obviously a higher material cost, but that additional incremental revenue that it's giving you does help you on the bottom line as well. So overall, we find this to be very profitable for all the industry organizations, assuming that you're getting them still at fair prices, right? This is not for any bundle package. There are companies who are offering 100 tests at some 700,000-800,000 rupees. Obviously, that's not the same result for them. We are selling more premium wellness, premium bundle package, which means a higher quality, higher service. Patients and consumers are willing to pay a slightly higher price because they know they're getting a far better quality report. So overall, it still makes sense for us.
Okay. Very quickly, just one last question. You had plans to open 30 additional labs this year and 600 to 800 collection centers. Are you on track? And considering that there is going to be a more focus on opening your centers in Tier 2, will it be margin dilutive? Could margins in FY24 be under pressure on account of this?
So actually, if you look at it in FY22-23, we opened approximately 15 labs. We are in a process of an accelerated lab expansion from FY21 till FY25. Despite opening 30 labs 15 labs in FY22-23, our margin dilution was only 1.5% compared to pre-COVID, where we were at 27% EBITDA. We reported a 25.5% EBITDA in 22-23, and that was primarily because of this accelerated lab expansion. We will continue that in FY23-24 and 24-25 by opening 30 labs in each year. But we are aiming to keep our margins consistent at 25.5% for the next couple of years. And at the end of the lab expansion, which is after FY25, once with this margin dilution is not happening anymore because of the accelerated lab expansion, we can then hope to see margins expanding.
Just wanted to know your target share coming in from premium wellness, because that had increased to somewhere around mid-teens. What do you think it stabilizes at? What's your aspiration there? And in terms of new network as well, that contributed around 3 to 5% of your revenues. What's the target there?
So currently, premium wellness is about 15% of our overall revenues, and we're hoping to take it closer to 20. You're right, the new expansion contributed about 3% of the overall revenue. And we expect that will move up closer to 4 to 5% in the next couple of years as we accelerate the lab expansion as well as the collection center expansion. We are very much on track to open 30 new labs in FY23-24 as well as the collection center network. In fact, I think we're going to do much higher than the collection center network, much higher than what we had projected, which was originally about 600 centers a year. We're actually aiming to do closer to 800 centers every year. So I think we're certainly on track. We will continue to maintain margins despite the accelerated expansion. And we believe that this will bring good growth to the organization in the years to come.
By the way, Mangalam, there was a report that Google is their AI, I don't know what it's called. They basically a retinal scan. They're working with the Sankara Nethralaya, which is one of the top hospitals in Chennai, eye hospitals. And they're doing so a retinal scan will tell you the probability of a cardiovascular event a year in the next 1 year.
I mean, irrespective, you have to go to the doctor. I figured this because a lot of times...
No, I'm saying from a diagnosis perspective. I mean, you don't have to... it's a... Anyway, I mean, it's a completely new way of doing things. But you're right, Mangalam. I mean, it doesn't replace the doctor. I don't know. Ameera, you want to say something?
wants to come in on this.
Yeah, I was just saying, look, I think it's really exciting with all the innovation and technology. Lots of changes in healthcare. But we have to remember, any consumer, even if you do a scan and you feel, okay, I may have an... It's great for the awareness, but you will finally go back to a lab or to a radiologist to confirm it before you take any actions.
Great speaking with you, Ameera. Appreciate you joining in, and good luck and good chat as always here on CNBC TV18.